A very good afternoon to you. Let's get into our markets. Asian markets declined in today's session. This partly on the back of China reporting weaker than expected numbers for its industrial output and retail sales, raising concerns about the health of that economy, despite authorities lending both fiscal and monetary policy support. The US's sovereign rating being clipped was also attributed to the lower sentiment. Moody's downgraded US's rating from AAA to AA1, raising the alarm about the country's growing debt levels and budget deficits. The Nikkei share average declined by 0.7%. The Hang Seng Index ended the session flattish, down 0.05%, while the Shanghai Composite Index closed flat on the day. Well, there was certainly cheer on US markets on Friday. They ended the week in positive territory, with all three major indexes recording solid gains. The easing in tensions between the US and China cited as a key reason for a more risk-friendly mindset. A 90-day truce was agreed earlier in the week, helping to lift market sentiment. However, US futures do suggest that US markets will likely open in the red. This follows Moody's downgrading of the US's sovereign credit rating from a AAA status. The Dow Jones Industrial Average rose by 0.8%. The S&P 500 gained 0.7% at the close, while the Nasdaq Composite Index ended 0.52% in the black. All right, looking at local indicators, currently we see that the all-share index is down 0.9%. The rand is trading at 18.02 against the US dollar, 20.30 vis-a-vis the euro, and 24.13 against the British pound. On the commodities front, we see that gold is trading at $3,237 an ounce, platinum at $994 an ounce, while Brent crude oil is trading at $64.59 a barrel. All right, let's get into the markets with James Turp. He's the head of investment strategy and fixed income portfolio manager at Sanlam Investments. Thanks very much, James, for joining us. So Moody's downgrading of the US's sovereign credit rating from AAA, was this always on the cards? I mean, especially because concerns have been raised for quite a long time, a number of years, in fact, about the high level of US debt. I mean, I think it stands at something obscene like $33 trillion US dollars. And of course, investors have decided not to really invest in anything that's US denominated as they would before. As we saw when there was, flight from equities, we saw that instead of going into US treasuries, investors were going into other assets like gold and even Japanese bonds and so on.
Thanks very much for having me, Nampu. Exactly. Okay, so the question around Moody's is they're actually coming in line now with the other two rating agencies, Fitch and Standard & Poor's, who did downgrade the US sovereign back in 2011 and 2023. So around those, just post GF's global financial crisis and just coming past COVID, the other two acted. So they're coming in line here, Moody's. But of course, the markets are reacting, and we're seeing dollar assets, as you say, coming under pressure. You've seen bonds across the US curve moving higher, moving steeper, because this is a reflection of the fiscal situation, as you say. There's huge amounts of debt that the US is loading up on, and at the same time talking about tax cuts. So on the fiscal balance as well, putting a little pressure there. So those ratings reflecting some of that. We're also seeing the dollar as measured by the dollar index, as well as against our own currency, coming under a little bit of pressure too. So, yep, Moody's coming in line, but markets are responding at the moment.
Yeah, but I wanted to ask you, I mean, do you think that given what has happened this year with the whole reaction to the US administration's trade tariffs, the very bad reaction to that, of course, things have now tempered because Donald Trump has kind of reversed his action, and there's a 90-day reprieve between China and the US in terms of those trade tariffs, but it could still be revisited. Do you think, given what has happened, that actually the United States can no longer rest on its laurels when it comes to the US dollar as the global reserve currency, because there does seem to be a move away from it.
That's right. You are absolutely correct. I think the act by Moody's is also probably their hand was a little bit forced because of all the uncertainty and volatility that has come from this US foreign policy, these tariffs that they've put on and then taken off, and having all of the uncertainty, I think probably made Moody's kind of go ahead with this action. You're quite right. We're seeing some figures where China, whose foreign assets were denominated in dollars and held in US treasuries, we've seen the UK overtake China in their holdings of dollar-denominated assets. But definitely we've seen China, we've seen Japan and other countries reducing their holding of treasuries, trying to diversify their foreign reserves. So it is, as your question asks, that the US can't sit on their laurels and wait. They've got to actively restore confidence in the dollar that always was there, or they're going to see this move away. As you say, other assets will be looked at, such as gold and other countries' bonds, as stores of value.
Yeah.
So it is a warning to the US.
So with the latest poor data coming out of China, are there concerns about the kind of impact that the trade war will have been having on on China and the United States, even though now there is this reprieve? But that in itself means that there's an uncertainty, because we don't know, how Donald Trump is going to wake up 80 days from now and what he'll decide around trade tariffs.
Yeah, I did see a headline just on Trump saying at the weekend that he's happy to go and talk to Chinese Xi Jinping and try and work on relationships there. So that is obviously coming front and center over there at the moment. But those Chinese figures, industrial output, better than expectations, though still on a declining trend. And it was more the retail sales that was the concern there, that demand still weak. So China having to do additional, stimulus seems to be the requirement there. And this is a problem, obviously, for global growth as well, with China demand still subsiding over there.
Yeah, let me permit you to give yourself a good cough while I ask my question. So separately, S&P Global, they gave a verdict on South Africa's sovereign credit rating late on Friday. They kept the country's credit rating unchanged, but raising warnings about the speed with which structural reforms are taking place in the country. And it's also interesting that they chose to do this just before, Budget 3.0, because the Finance Minister, Enoch Godongwana, has indicated that there are going to be massive revisions to things like growth and therefore revenue and maybe even expenditure. So very interesting that they would do that. But your thoughts?
Yeah, I think the timing is curious. I would personally, if I'm a rating agency, I'd want to see that budget. I'd want to, be comfortable with it. And then I would affirm the rating as positive. But we're grateful, of course, that they have. Perhaps, the DA coming out and saying that they believe this new table budget to be credible addresses the fiscal spending side. I think they probably will have tabled this new budget with a more cuts to spending, which would please, I guess, and make it a more credible budget in the absence of the VAT hikes. So perhaps it's that. Perhaps S&P have had some insight into the feel of the new budget anyway, that has given them sufficient confidence to go through with that. But it's just an affirmation, and those warnings are there, and we're all aware of that, those implementation risks that we've got. So it's good to see, though, and it came over the weekend. But they are warning that there's, of course, a lot of work still to be done.
Indeed. Well, we're going to leave it there. But as you say, maybe if the National Treasury or government does decide to start cutting a bit more, they need to be careful not to cut too deep, because then it could affect service delivery. And of course, South Africans wouldn't want that, just as they don't want a VAT increase. Thank you so much, James, for your time and insights. As always, that was James Turp. He's the head of investment strategy and fixed income portfolio manager at Sanlam Investments.